what's up everybody? It's Tuesday, January 11th. How's everybody doing? Good day in the mercado, in the market. Everything was up today. Powell testimony. The spin on that was, you know, he pulled back a little bit on the hawkish rhetoric, but all of that stuff to me is irrelevant. I mean, what it does, it just triggers the reaction of investors. You know, the market is based on the economy and the growth in the economy, and when you get these reactions based on emotion and people not understanding anything about monetary policy, and worse, putting all the emphasis on monetary policy when you don't even understand what it is, you know, that's just stupidity. All right, so really, when you think about it, anytime you see these pronouncements by Fed officials that cause these market corrections, I mean, those are buying opportunities. You know, if the Congress or the government were to come out and say we're going into a deep austerity, then that's a different picture. But as I've said so many times, that is highly unlikely, because the four main components of government spending, you know, that's Social Security, Medicare, Medicaid, and defense. And the first three, they're just in an automatic expansion because of the aging of the baby boomers. I mean, the baby boomers become eligible for that stuff. Look, I'm gonna be eligible for Medicare this year, which I'm absolutely gonna take. And I have really, you know, the highest level private health insurance right now, but I'm happy to take Medicare and Social Security. But anyway, so those things are not gonna shrink anytime soon, you know, because we're still in the bubble of the bulge of that baby boomer generation that's reaching retirement age. So the recipient rolls of all those programs are going to continue to grow, even if there's not yearly increases, which this year we even get an increase on top of, you know, the natural growth rate in the number of recipients. And then there's defense. And the Republicans are never going to cut defense, and even the Democrats go along. Look at the last defense bill. I mean, when they were haggling over really minor numbers, you know, like the child tax credit payment and stuff like that, and the Democrats were split. You had Manchin, who, you know, scuttled the whole thing. He just, you know, threw the whole thing under the bus. I mean, they all signed on for the $770 billion defense bill without a problem. Both sides, it was bipartisan. It went through without a hitch. So that's never going to get cut. All right, but the other thing I've been telling you about is this bank data, the bank data. Now, you know, government spending is slowing compared to last year. There's no question about that, and that's plainly obvious. You can see it. There has been a moderation in the flows. But now you have, and also I should mention that the deficit is shrinking like crazy. I mean, we're looking at maybe a 460 billion deficit for the year. That's down from 2.9 trillion last year. I mean, that's not like going from 2.9 trillion to 2.5 trillion or even to 2 trillion. That's 2.9 trillion. Hang on, down to 468 billion. I mean, that's a big drop. And that represents a decline in the stock of financial savings, dollar-denominated savings. But that is being replaced right now by bank credit. And this is natural. When the government pulls back, the private sector, the non-government, tends to go deeper into debt. That cash flow is replaced by credit, by bank credit. Two kinds of money, right? You have vertical money, that's the government's money, that's high-powered money. You get a check, that's yours to keep. You put it in your pocket, Social Security, you put it in your bank account. Your net worth has gone up, all else equal. You know, that's an addition to your financial balance. If you get a loan, yeah, you get a credit in your checking account, but you also have a debt, and so your net balance does not change. It may go up if you invest wisely, but you have that debt and you have to pay it off with interest. Anyway, bank credit has been rising. I've been saying that household debt burdens are still at a very, very low level. Okay, they're not like where they were in 2007 when they got up to like 13% of disposable income. Now they're around 9% of disposable income. You know, that's a very reasonable level. We're going to see an upward trajectory in that, but it'll take some time. In the meantime, bank credit will replace what's lost on the fiscal side, and that will sustain economic growth. So, again, I mean, I gave you a whole bunch of information here, and, you know, to me, it makes Powell's comments kind of meaningless. I don't pay attention to it. You know, if I pay attention at all, it is how investors react, and I know how they're going to react. They always react the same way. I mean, you know, to 99, let's call it 100% of investors, the Fed, the central bank, is the primary focus when they think about any kind of policy impact on the markets and the economy. And that's just wrong. I mean, that's just misplaced. You know, that sets you up. You know, if you're going to follow that, you're going to get this whipsaw, choppy action. You need to have a big picture, and the big picture is understanding really the macro and the fiscal and what goes into it. I want to talk a little bit about the American Petroleum Institute released their inventories this evening. We saw another huge build in gasoline. Crude was down, I think, 1.1 million barrels. So that continues to draw. But the interesting thing for me is gasoline inventories up almost 11 million. I mean, last week they were up 10 point something million. We are now seeing gasoline inventories are now the highest in a year, okay? The year-over-year deficit has been basically erased. I mean, we're flat inventory-wise year-over-year. So whatever deficit there was in terms of stocks of gasoline, that's gone. I mean, we're in balance compared to last year. And it goes back to what I've been telling you. You know, I've been telling you about commercial and industrial loans, which businesses use to finance inventory. That would also include gasoline inventory. Look, take a cue from gasoline. The rise in inventories, and I've been saying this to you, you're going to see a rise in, you know, the shelves are going to get restocked. I mean, this is the sign that we've been waiting for, that I've been waiting for, to signal that the supply issues are starting to ease. I mean, when companies now are turning to banks and they're, you know, tapping C&I loans, that means they're able to get inventory. Before, these loans were contracting at a furious, like, historic pace. I mean, they just were crashing because even if a company wanted to finance inventories, there was no inventory to get. I mean, you had all these supply chain issues. But the fact, and this was a great leading indicator, and I've been telling you about this, the fact that commercial and industrial loans have been rising now for like 6 weeks in a row. They're at the highest level in 7 months. I mean, this is telling you right now that stuff is starting to move. We're gonna get a replenishment of commercial inventories, not just gasoline, but other things, you know, that have been tight. And this is going to help with the inflation picture. Now, I said really February is when we should start to see much better inflation numbers, because we're going to get that OPEC output increase in February, and that should lean on the crude oil price. Right now, gasoline, you know, I'm telling you, with this inventory rise, we're going to see some pullback in gasoline prices. I mean, the relief at the pump still has a ways to go. So that's good news. In any case, I think that the market has already discounted the Fed and its hawkish stance and its hawkish comments. And I think we are probably in a recovery mode for the market right now. I think it has really digested the idea of 3 rate hikes this year. I don't think this is such a fear anymore on the part of investors, and we should see how this plays out. I think the economy should be fine based on the expansion in bank credit, and let's face it, the fiscal has moderated, yeah, but it's not caving in. So with that, I will leave you and I hope you have a good evening, and I'll see you tomorrow. Bye.